Mark, great to see you. Do you think we'll get a pause today? And what happens in 2024 with rates and the Fed, in your view?
Well, good morning. And I think we do get a pause today. There's really no reason for the Fed to continue tightening. And if they start loosening too soon, that sends an awful signal that, hey, we were wrong. We raised too far, too fast. It would be rather unsettling because it also could indicate there's weakness in the economy. So rate cuts, even though Wall Street seems to want them, isn't really going to be great news at this point, because if the Fed starts reversing course, that means they see serious underlying economic weakness. We think it's level for longer. They stay steady today. Maybe next year they pull back one or two of those last quarter point hikes, but we don't think it embarks on a new rate cut cycle, even if they do that mid-year next year.
Even though inflation is not where their target is, right? I mean, we're still talking about elevated inflation, even if it is off of the worst levels of the last year. We've got the November CPI coming out this morning at 8:30 a.m. Economists are expecting the month-over-month price to remain unchanged for the second month in a row. And year-over-year, we're expecting prices to be up 3.1%. Then we'll get the PPI, Producer Price Index, out tomorrow. And, of course, retail sales on Thursday, Mark. We'll get a good window into how things have slowed down with those retail sales number. Has the consumer become tapped out, in your view, yet?
Well, the consumer is feeling the brunt of these cumulative hikes, and it's interesting with the lags. You can't really tell how far the consumer is being pained by all these rate hikes. But what we can see is a weakness in consumer credit. We see an increase in credit card balances, an increase in delinquencies, and we're going to see the trickle effect into the financial sector. So what the Fed wanted to do is working, and that is the Fed can control those levers that relate to financial costs. They've raised those financial costs to slow down the economy, and it is going to have a lag. Look, after the pandemic, people had this fear of death, and there's nothing like a fear of death from a multi-year pandemic to get people go out and spend. But eventually, that spending will slow and stop when you no longer have money to do so. And I think in 2024, we're going to get a return to a little bit more. I don't know if it's going to be prudence or it's just the reality that there isn't enough money to continue this revenge travel that we've seen and other spending. I understand earlier it was mentioned that inflation target is 2% and we're still at 3%, and yet the people are thinking the Fed's going to ease. Those three variables don't connect.
Right.
So that's why I think it's going to be level for longer. The Fed has not hit the 2% target. We're on a trajectory, but remember, that also doesn't include the impact of the three huge government spending bills that are going to be rolling out next year. It doesn't impact some of the undercurrent we're seeing in the wage market. I know wages have been suppressed a little, but that's not stopping unions from getting very, in some cases, well-deserved, but pretty high and massive increases. So there's an undercurrent here, cross currents in the wage market. There's government spending. There's reasons to believe that inflation isn't buried. It's still over the Fed target. So calls for a relaxation of monetary policy after, remember, the Fed engineered one of the largest inflation spikes in history. So I think that it's optimistic for stocks and optimistic for people to think that Jerome Powell is going to say, whoops, we're going to pull back now just a few months after the last hike.
Yeah, it makes sense. Mark, it's good to see you this morning. Thanks very much.
Good to be here.